Hi guys, my name is Tanisha. I am a real estate agent in the state of North Carolina, and I just passed my mortgage loan officer exam. And so I wanted to create this series to help anybody that's thinking about becoming a mortgage loan officer or getting ready to take the exam. The steps I took to become a mortgage loan officer are: number one, you go on the NMLS website and get your unique identifier number. Once you do that, you sign up for the 20-hour MLO course. I did mine online. It's like a self-paced course. You can do it online. I did it with CE Shop, and this isn't sponsored. That's just who I used. Once you do that, you take the 20-hour course, then you are going to schedule your exam. Once you schedule your exam, the exam is $110, and you have to go into a testing center and take it. The website still has the option that says like take it at home, proctored, but you cannot do that. That was only for COVID. Ask me how I know because I selected that option and they sent me an email saying that you can't take it at home. You have to go into an actual testing center. Once you get to the testing center, you take your ID in. That's all you need. They'll give you a locker. They'll give you a calculator. They'll give you a whiteboard with a dry erase pen to like do scribble or do whatever. Um, and then once you take your exam, hopefully pass. Um, now, if you do not pass, there's a 30-day waiting period. So you could take it and not pass, and there's a 30-day waiting period. After the third test of not passing, you have to wait 6 months. So I hope no one has to go through that. After you take and pass your exam, then that's when you actually complete the application. It's called the MU4, and you go on the NMLS website and complete the application. After that, you're going to get fingerprints and you're going to pay for a credit check. They're going to run your credit. They're not looking for the regular stuff that's on the FICO score. They're looking for like big things that you owe the government and didn't pay and stuff like that. You have to score 75% or higher. There's 120 questions and you have 190 minutes to take it. So that's like 3.1 hours to take it. The test is 100% computerized and you will know instantly if you pass or fail the test. You have to get a 75% or higher on the test. And if you're like me, you're like, how many can I miss? So it's 120 questions on the test. You have to at least get 90 right, which means you can miss 30. That's a 75. So, because I always do the math like, okay, how many can I miss to have to pass? So it's 30. 30 max questions you can miss. It's only like two or three. I only had two or three math questions. So I know a lot of people want to focus on the math. I personally wouldn't focus on the math because I would know how to do some of the math, and I'll do a video on like a few of the formulas. But I personally like even if you miss all of the math and you get the majority of everything else right, you can still pass the test because it's only a couple math questions. Like I literally had two, maybe three math questions on my test. Now, just because I had two or three, I mean, you're going to have two or three, but the consensus usually is it's only a couple math questions. Um, and then once you pass and do all the things, become MLO, start working every year, you will have to do 8 hours of continuing education and pay your fee and have your continuing education done by December 31st. The window opens on November the 1st. So you have from November the 1st to December the 31st to pay your fee and get your continuing education done to renew your license for the next year. There are a few big topics on the exam that I think everybody should know, like in and out. One of them being RESPA. RESPA is a big part of the exam. So I'm going to go over RESPA and tell you how I remembered it. And then I'll tell you the actual definition. And then I'll tell you how I would explain it to like a 10-year-old kid to kind of help you also understand it. If you understand what RESPA is and what it does, you can pass all the RESPA questions on the test because they'll try to throw you curveballs. Like the MLO test will try to throw you curveballs and confuse you. But if you know what it is and what it does, then you can fly through the questions and not have to worry about it. So what is RESPA? RESPA is the Real Estate Settlement Procedures Act, and it aims to protect consumers by ensuring they receive disclosures about the cost of real estate settlement and eliminating abusive practices. It helps consumers become better shoppers for settlement services. If I was explaining this to like a 10-year-old, I would say, let's say you're at a toy store. You're going to buy a toy, but before you buy this toy, the person that's selling you the toy has to tell you how much the toy costs, how much the taxes are on this toy, and if there's any extra fees associated with this toy that you're about to buy. RESPA makes sure that when people buy a house, the banks and the real estate people tell them exactly how much they're going to pay and when they need to pay, and if there's any whatever fees will be accrued, all of that. Why does this matter so much? It matters because no one is surprised by hidden fees or costs at the last minute. Everything is clear from the beginning. That is the whole point of RESPA. So on the test, I'm going to go over a few things that I made mental notes of while I was taking the test. The regulation is X. Regulation X is RESPA. And the lady, when I was studying, the lady that I was watching, her name is Shirley. She's with Infinity. They have videos on here as well. She said that she called it REXPA, so that you can remember that it's Reg X, RESPA. So RESPA covers 1 to 4 unit residential properties owner occupied. It does not cover all cash sales, rental properties, properties with more than 4 units, commercial properties, properties over 25 acres, which is agricultural properties. Violating RESPA could result in a fine up to $10,000 and or imprisonment up to a year. There are 4 different sections of RESPA that the test focus on, and so I'm going to go over those so you can know which sections to study. RESPA Section 6 is about mortgage services. So it protects homeowners against mortgage servicing abuse and the servicer's obligation to correct errors asserted by mortgage loan borrowers. So RESPA Section 6 is about mortgage services. RESPA Section 8 prohibits kickbacks, fee splitting, and unearned fees. RESPA Section 9 is about title insurance. So it states that a seller cannot require the use of a particular company as a condition of the sale. So if this is violated, the buyer may sue the seller for 3 times or what they call treble damages of title insurance charges. So that's important because they did ask about that, about the being able to sue for treble damages. RESPA Section 10 deals with escrow accounts. So it identifies the amount that can be charged and maintained in escrow accounts. No more than 1/12 of annual property tax and annual insurance premium. So RESPA Section 6, mortgage services. RESPA Section 8 prohibits kickbacks, fee splitting, and unearned fees. RESPA Section 9 is about title insurance. RESPA Section 10 is about escrow accounts. If you can remember those things, you can answer those questions on the test when they come up. TRID stands for TILA RESPA Integrated Disclosures. It created the loan estimate and the closing disclosure. And the primary purpose is to make mortgage costs clear and prevent surprises, ensuring borrowers get important information with strict timing, like the closing disclosure, the 3-day closing disclosure rule before closing. So if I was explaining this to a 10-year-old, I would explain it like this. Let's say you're going to buy a bike and you need to know exactly how much it will cost. The store gives you this long list with different numbers and taxes and delivery and hidden fees, and it's hard for you to figure out how much you're actually paying. TRID is the rule that says the store has to give you a simple, clear list to show you exactly how much everything will cost up front so you won't be surprised. Treat, like I said, created the loan estimate and the closing disclosure, and it just makes sure that you have a clear understanding of what you're paying for. So let's talk about the TRID timeline. So there's each disclosure has a specific time at which it has to be given. So let's talk about the disclosures that have to be given at or within 3 days of a loan application. Those disclosures include the initial disclosure, the home loan toolkit, which is a know before you owe, and the mortgage servicing disclosure, and a list of HUD approved home counselors. All of those are RESPA disclosures, and they have to be given at or within 3 days of the loan application. The TILA disclosure that has to be given at or within 3 days of the application is the loan estimate. So these things have to be given at or within 3 days of the loan application. So before settlement happens, you have to sign an affiliate business agreement if you're going to be providing more than one service for the consumer. So I am the mortgage loan officer, and I'm also a real estate agent. And if I do both of those things for one loan, I have to provide this affiliate business agreement because I'm providing more than one service and I'm getting paid for those services. Another example is if I am the mortgage loan officer and the house you're buying needs new floors. If I own a flooring company, if I own more than 1% of that flooring company and I refer you to that flooring company and you decide to go with that company, I have to give you an affiliate business agreement. Meaning I'm telling you, I'm disclosing to you that I'm going to be getting paid multiple times during this transaction. That's what an affiliate business agreement is. And that has to be given before settlement if that's the case. 3 days prior to consummation is when you get to the closing table and you hand over ownership. 3 days prior to that, you have to get the closing disclosures. Okay, so at settlement, the final closing disclosure will be given, which is a TRID document, and then initial escrow account statement, and which is a RESPA document that will be given within 45 days of closing. After settlement is the annual escrow statement will be sent to you, servicing transfer statement if that happens, like if the loan servicing change, or if they sell your loan, like sometimes like Wells Fargo will sell your loan to Bank of America or whatever. They have to send you a goodbye letter. All of this is after settlement. All of these are RESPA disclosures, but those will be done after settlement. The next topic we'll talk about is HMDA. The acronym is HMDA, and it stands for Home Mortgage Disclosure Act. And again, shout out to Miss Shirley for this mental hack. It's Regulation C, and she said that it allows regulators to see where possible discrimination is taking place. It is designed to identify possible discriminatory lending practices. It requires lenders to file reports regarding the ethnicity, race, and sex of all applicants. These reports are called LARs, LARs, Loan Application Registration, and this information is found in Section 10 on the 1003 loan application. So on the loan application, it'll ask you sex, race, all the things. And this is to help them identify any discriminatory lending practices. The primary purpose of HMDA is to provide the public with loan data that can be used to determine whether financial institutions are serving the housing needs of their communities and to identify possible discriminatory lending practices. HMDA requires lenders to collect and report specific loan data annually, including information about the applicant, loan type, and property location to help identify discriminatory lending practices. So if I was explaining this to a 10-year-old, I would explain it like this. Let's pretend you're borrowing a toy from a store, like a toy car from a store. But the store owner notices that only boys are getting lent these cars. HMDA is a rule that says y'all need to start lending to some girls to make it fair. It keeps track of who is getting loans to make sure no one is being left out or treated unfairly. Why is this important? It helps make sure that everyone, no matter where they come from or who they are, get a chance to borrow money if they need it. That's HMDA, Home Mortgage Disclosure Act. Let's talk about ECOA, which is Regulation B. It is the Equal Credit Opportunity Act, and the mind hack, again, shout out to Miss Shirley. I'm gonna give credit where credit is due to help me remember this. She said that lenders have to be equal when extending credit. So, Equal Credit Opportunity Act, Regulation B, you have to be equal when extending credit to consumers. What is ECOA? ECOA is a federal law that ensures that all consumers are given an equal chance to obtain credit. ECOA prohibits credit discrimination based on race, color, religion, national origin, sex, marital status, age, or public assistance. Denying credit based on age is illegal unless age is a valid predictor of credit worthiness. The primary purpose of ECOA is to prohibit discrimination in credit transactions. ECOA requires lenders to provide a written statement of reason for denial when denying a credit application. If I was going to explain this to a 10-year-old, here's how I would do it. I would say, imagine you want to borrow a toy from a friend, and this friend says, I ain't letting you borrow this toy. You got on a red shirt. Remember, I'm talking to a 10-year-old. ECOA says that you should be able to borrow toys, or money in this case, no matter what you look like, where you live, or who you are. Why is this important? Because it stops people from being unfairly treated because of things like gender, race, or where they come from. Because of ECOA, everyone gets a fair shot at borrowing money or getting a loan. So, another important part of that I want you to remember with ECOA, it prevents discrimination against public assistance. That's one of the 8 protected classes of ECOA. And examples of public assistance include Social Security, child support, alimony, any type of non-taxed income is public assistance, and it is a protected class under ECOA. A hint is the first 5 on the protected class list are the same as fair housing. So the difference for ECOA is that the last 3, which are age, marital status, and public assistance. So it gives it a total of 8 things that are protected under ECOA. Also, ECOA also deals with appraisals, and sometimes that's hard to kind of tie the two together. But according to ECOA, a borrower has 90 days to request a copy of an appraisal, and a lender has 30 days to deliver the copy. Also, under ECOA, the borrower has the right to challenge the value stated in the appraisal. So I think there's a disconnect because ECOA is like about being equal when with credit and stuff, but also a little piece of ECOA is appraisals. So y'all remember that for the test. A couple other things dealing with ECOA. ECOA disclosures must be retained for 25 months. Remember that for the test. Civil action may be filed for ECOA violations for up to 24 months or 2 years if a consumer believes his rights have been violated. So you can file civil action for 24 months, and the disclosures must be kept for 25 months. According to ECOA, the only correct way to ask about marital status is, are you married, unmarried, or separated? That's it. ECOA states that the creditor cannot ask the borrower about childbearing or child rearing, and penalties for non-compliance is $10,000 for each individual action.